All right. Thank you, Darrell. Could do a quick sound check here and say hello to Mars there in the background. He sounds super excited. I think he sounds, if Mars could talk, I would like to tap into his energy and have him do the webinar. I think that would be awesome. Perfect. Okay, great. So tonight's webinar, now I did one of these last week to a much smaller group. If you were there, this is a similar presentation. It is got a few extra slides, little extra tidbits of information, you know, just kind of more up to the minute stuff based on what we've been seeing. And then if you were not participating in that one, this is just kind of a way just to really understand what is going on in the current market so it actually makes sense, but more importantly, to know what to expect going forward. Okay, so you don't just, you know, not only just wondering what the market's going to do, but how's this going to impact the economy? You know, are we in the, you know, are we starting off in some kind of a potential 2008 kind of, pardon my French, shitstorm that if you're not prepared for it, you're going to get hosed? Or is this something that's like, okay, this is just, you know, we're going to go to new highs and it'll all be good? As long as from a trading perspective, as you understand what's going on behind the scenes, it then allows you to kind of prepare for what's happening now. Okay, and if you can understand what's coming down the pipeline, you not only can make trading decisions, but you can make decisions on, you know, real estate. You know, do you buy a house here or do you wait? Are the things that you should unload now and you could buy them back at a cheaper price in a couple of years? Just kind of stuff like that. Or, you know, is gold going to be a good buy? So, oh, cool, you got the book, Dave. That's good. So yeah, fantastic. And all that kind of fun stuff. Yeah, and these kind of markets, they're fun. And oh yeah, sorry, that actually should say today. So that's my bad. Let me change that. So today is what, December 27th? Yep, still 27th all day long. So we'll dive in and just kind of look at this here. Oh, thanks guys. Yeah, so the third edition of Mashing the Trade is finally out. So some of you are starting to get it in the mail. That's great. And yeah, so sections 1 and 3 are pretty much completely updated, and then the middle part with the setups has been kind of trimmed up a little bit, and but really, and some great insights from Henry and Danielle in there, and then Darrell's covering tech, and so I really like it. I think it's a book that most naturally represents kind of where we are now, and the people that we're working with now and we're involved with now, and it's all, you know, all great stuff there. Fantastic. Oh, awesome, Ron. That's great. All right, so let's dive into this. So a big part of this, again, is just really understanding what's going on in the world today so you can be prepared for it, okay? And what's the name of the book? So there's a book out. I wrote the first edition in 2005. You can get it on Amazon. There was an edition in 2012, and then the third edition just came out last week, and it is called Mastering the Trade. And it would be by myself, John F. Carter, of Earth and not of Mars. Okay, so that's the book. So what I want to do is talk about the road ahead in 2019. All right, so as we head into 2019, it is important to understand we are entering a different era. Okay, and I'm going to talk about the similarities of where we are now to, I mean, really the last time we've experienced what we're experiencing right now was from 1929 to 1933 in terms of specific monetary policy. And so we want to understand what happened there. And then in 1937, when they actually started to tighten, and what happened after that. Okay, remember, what bailed us out of all that was a war. Okay, and we're actually setting up the same situations for that potential same thing to happen here. Because believe it or not, the reason wars start is because of different countries vying for economic power. Remind you of any situation that's going on today, and they get the opportunity to do that when the strongest countries out there start to weaken. So some really fascinating, interesting, potentially scary stuff on the horizon. Yeah, I am in full agreement. It'd be good to skip the war this time around. One of the things I think is that the weapons today are so powerful that nobody can afford a real war. I mean, what I mean is like a global scale war. I mean, I could be totally wrong on that. I am a history major, studied military history, but that's the difference between today And say World War II is just the weapons that are available today. Where people are like, you know what? Let's can we talk this out, or let's just do some skirmishes over here. And yeah, an economic war is kind of the real war too. So here's a couple of things to keep in mind. So the main thing to keep in mind right now is people's perception of what is happening. So at this time in December last year, okay, so right now, here we are, it's December 27th, 2018, okay? So what I want you to do is get yourself in the mind of the average investor in December of last year, okay? What were they thinking? And I don't mean just yourself, but any retail investor, but most importantly, money managers. What were they looking at? Did they feel like that they were capturing the increase in asset prices that were taking shape, or were they missing out? Okay. And if you look at what was going on in their minds this time last year, investors would look back over the prior 2 years of trading, okay, all of 26 and all of 2017, and this is what they saw. They saw 24 months of asset appreciation. They saw that no major asset class lost money. Even bonds made money, okay? Real estate made money. Stocks made money. Every major asset class returned double digits. And a lot of this in stocks, of course, got funneled into the FANGs. And they were responsible for much of the gain in all the indexes. Okay, there's a couple of reasons for this, but bonds, stocks, gold, you name it, everything appreciated double digits. And what did this create? This created FOMO. FOMO is a mental state where anxiety is induced due to the fear of missing out on something. Okay, and with investors, what that does is cause them with reckless abandon, okay, to put money to work. This happened in Bitcoin as well, fear of missing out. People were taking out mortgages when it hit 15,000. So FOMO, fear of missing out, we hit this in January of 2018, and a record $100 billion, okay, in 1 month poured into the stock market. If you remember January of 2018, the FANGs exploded, the markets exploded, okay? And even with that February blip now, when the short volatility funds exploded and the markets went a little nuts, we basically rallied right into 2018. September 2018. We want to keep this in mind because the U.S. was the only market that rallied into September 2018, and there's one reason why that happened, and we'll explore that as well. So now, here we are in December, okay, in December of 2018, and it is much different look back period and story from December of 2018, okay? So if you're sitting here right now and you're thinking about, gosh, what I want to do in 2019, I want to put some money to work. So we have a couple of things going on. So first of all, sentiment right now is a lot worse. Okay, obviously the markets have come down pretty solidly. There's a lot of talk on the radio and TV and financial press about, Great Depression. This is the worst sell-off since the Great Depression. Yada, 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 yada. The main point here is that the sentiment right now is a lot different in December 2018 than it was in December 2017. The sentiment puts people in the mindset of, ooh, I need to protect what I have. That means I need to take money out of the market versus having FOMO and fear of missing out and putting money into the market. Okay, so we're going to have a very different January this year than we did last year. Last year, we exploded higher. And on top of this, we've got the very real problem with the Fed, okay? With quantitative easing, now for those of you that aren't familiar with these terms, so QE means quantitative easing. This is what started in earnest in 2008, and it ended in February of 2018, okay? So with quantitative easing done, we are now into QT, which is quantitative tightening, okay? The Fed is either easing or tightening to varying degrees. And this is a shift that's happening on a global scale with every major economy shifting to QT, okay, except Japan. Japan is still full-on quantitative easing, okay? Now, the EU is about to go to QT, I believe, in January. So what does all this mean? So a couple things to keep in mind here. Remember, QE, okay, now this is not about inflation or deflation. It's about asset prices. QE is designed to inflate asset prices, okay? So what are assets? Stocks, bonds, real estate, okay? tangible assets. It is designed to inflate those prices and create essentially value that credit can be loaned against, okay? QT, quantitative tightening, is designed to deflate asset prices, okay? So the most important thing to keep in mind right now is we are in an environment where we have switched from 2008, okay, to about February of 2018, where the government was actively inflating asset prices, to starting in February 28, it's actively trying to deflate them. So we got to understand the government is trying to deflate asset prices. It's not trying to wreck the economy. It's just trying to deflate asset prices. Okay. Now you don't want to confuse this with inflation and deflation. Think of it as appreciation and appreciation and depreciation. If you've got a house, if it's going up in value, it's appreciating. If it's going down in value, it's essentially, we call it, it's depreciating. Or now, it is no accident that EEM, that's the ETF that measures the emerging markets, peaked within 2 weeks of the Fed starting to shrink its balance sheet. Okay, so we got to understand what that means. So if we look back here at the EEM, okay, a couple things here to really keep in mind and that really stand out is that very shortly after the government essentially announced we are done with QE, okay, and a lot of people didn't pick up on this, we are done with QE and we're now switching to QT, right? We're now switching to QT. Emerging markets, which fully depended 100% on QE from the United States, okay, that's the only reason why they were going up, peaked and fell and fell and fell and fell and fell and have just been selling off ever since. Now, during this time, I want you to notice that, yes, the S&P stock market also peaked, but then magically recovered. Okay, we want to keep this in mind. The United States market recovered and rallied when almost every other market out there was doing this. Okay, so just remember that, sock it away, and we're going to come back to that. So it's important to remember that QT, i.e. quantitative tightening, is not just the Fed raising rates. So a lot of times people mistakenly think that when we're doing quantitative tightening, it just means, oh, the Fed's raising rates. Gosh, if they would just stop raising rates, everything would be fine. Okay, that's not true. And the reason that is not true is because of their balance sheet. So there's two things that happen when there's major quantitative easing, okay? You lower interest rates, and then you also essentially print money and buy back debt, okay? Buy debt. And when you print money and buy back debt, that expands the government's balance sheet. And you don't even need to understand this. Just understand that the government balance sheet expanded by like 400% during this time. Now what they're doing is they're contracting that balance sheet, okay? That means essentially it's taking away money that was printed, all right, and then not buying any more debt, okay? That also has the impact of quantitative tightening, all right? It's one of those things that it doesn't make sense, it's behind the scenes, but it's actually the bigger driver of quantitative tightening. So in summary, the major central banks will have policies in place that generally depreciate asset prices all through 2019. And I want to point out here that even if they stop raising rates, they're going to still shrink their balance sheet. So we're still going to see depreciating asset prices. Okay. So what does all this mean? So also keep in mind that the economy and the market react to only three things, okay, and that's it, over the intermediate and long term. It's just three things. Again, stock markets and the economy. The first thing, sorry, I'm coughing a little bit here. The first thing and the most important is productivity growth. And we'll talk a little bit more about this. But this does not impact the short term because productivity growth is not volatile. You know, if you look at GDP numbers, it's like, oh, we're at 2.8%. And then we're at 2.6%. And then we're at 3.4%, right? It's not very volatile. So productivity growth is important, but it doesn't really impact the short term that much because it's not very volatile. We'll talk about all the things that go into this. And then there's the short-term debt cycle. This is 5 to 10 years. okay? And then there's the long-term debt cycle. And essentially, this is the short-term debt cycle is essentially, think of it this way, as releasing credit to stimulate growth, okay? And then at some point, it's restricting credit to slow down growth, all right? So generally, everybody wants economic expansion, but they don't want it too fast. If it's too fast, it gets dangerous. So they're releasing credit, trying to keep things moving along. Oh my God, it's getting a little too tight. It's getting a little too faster. It's getting a little too heated up. Let's restrict credit a little bit, i.e. raise rates, quantitative tightening, and let's slow things down. Okay, that's the short-term debt cycle. The long-term debt cycle is essentially a group of these 5 to 7 or 8 short-term debt cycles, and this happens every 50 to 75 years. Okay, so what does that mean? So if we look at this stuff, because we want to understand where we are right now and how that is going to impact the markets going forward. So productivity growth, again, most important over the long term, doesn't have much of an impact in the short term. And all this happens through essentially a country's culture, the people, what's the education system like? What are the family values? Okay, what's the infrastructure, rule of law, and the market systems? Now, I mentioned rule of law here. So one of the organizations I'm a part of, it's called YPO. It's a really cool organization. You meet all these really fantastic people. And I met a banker from Syria. He had started a bank, grew it. It was publicly listed, and then Syria broke out into a war. Now, he saw what was going on here. He essentially lost his business, lost all of his possessions. He packed up his family and moved to Dubai. Now, he had the means to do so. There were a lot of people in Syria that did not. But essentially, what we were talking about here, and I met him at, it was at a conference in Palo Alto last year or the year before. It was called, they held it at the NASA conference, at the NASA place there, where you could actually sit there and just kind of do a deep dive into all the technical trends that were going on. And he happened to be there. And he just said, like, the thing that you guys have in the Western economies that you sometimes may not appreciate is you have the rule of law. You cannot have a dictator take over stuff and just, shut down banks and take over stuff. You have the rule of law. Your property is safe. Your businesses are safe. And it was funny because it's something that I'd really never thought about that much, but essentially a stable economy over the long term has rule of law, and that's applied. So anyway, short-term debt cycle. So we're at the end of one now. Okay, 2008 was essentially the start of a new short-term debt cycle where a ton of credit was thrown into the markets, and now that credit is being taken back. All right, so we're at the end of that. Okay, that's a tightening process, and it's now what happens here is, why is the market falling? Because it slows prospective earnings growth. Okay, right now companies are doing fine. It's like, oh my God, why is the stock market falling? Because the stock market prices in what earnings are going to be this time next year, and they know that prospective earnings, okay, are starting to slow down, and people are getting smarter about this. So instead of waiting for the earnings to start slowing down and then selling the stocks, they're just getting out now. Okay, that's why markets fall. And then the long-term debt cycle, the last time this started was in 1929 to 1933. We had the big bubble, big collapse, a lot of quantitative easing, got rates down to 0%, and then essentially in 1937, they had to start tightening again. Okay, well, the same thing happened in 2008 and 2009. Here, this went to 1937 before they started tightening. This time we went to 2018, so about 10 years here before we started tightening. But this is at the end of the cycle that started here. So essentially, we've got productivity growth slowing, and for the first time in most of our lifetimes, we're at the end of a short-term debt cycle and the end of a long-term debt cycle, meaning we have a lot of tightening kind of coming down the pipeline. So what is that going to do to the economy, and what's that going to do to everything? The other thing that we have going on here, okay, is that, okay, good question. Is it 10 years of easing and then 10 years of tightening? No, the tightening happens until they reach their objectives. Okay, and we're going to talk a little bit more about that. Actually, we could actually talk about that now. Let me grab this chart real quick. So here's the biggest problem, and there's a lot of problems, but here's one of the biggest ones. This is a daily chart of crude oil. Now, this collapse here from the highs at $75 in October, okay, to here we are at $46, okay. So for the last about 90-ish days, oil has plummeted. Now, this impacts inflation numbers. This impacts employment. This impacts profits. Now, none of this is going to hit what the government reads, okay, for from right now for about 3 to 6 months. Okay, that's how long it takes for this stuff to trickle through the economy and represent itself in the numbers that the government checks and says, well, we better keep raising rates. So all the stuff they're looking at right now is not showing any signs that inflation has stopped. Inflation is showing steady. They don't want to get runaway inflation, so they're keeping to raise rates. What they don't understand, and surely they understand it, but I guess maybe they just can't react to it, is that oil right here just killed inflation, okay? And it's not going to show up for like 90 days in all the numbers that they look at. So inflation's dead at this point. And so anyway, that's just kind of a, some of the things to look at there is like there's a little bit of a disconnect in terms of reality and what we can see happening versus what they react to, all right? And that's the one thing we got to keep in mind. So the Fed essentially is backed into a corner here. They don't want to drive, nobody wants to drive the economy into a recession, okay, especially with unemployment under 4%, but they aren't seeing any signs of an economic slowdown, okay? Now, with the price of crude oil the way it is and the quantitative tightening that's happening, guess what? It is creating a slowdown, okay? Company earnings are going to tighten up a little bit. We already, this is going to destroy inflation right there. And so they're going to look at that and say, oh my gosh, we got to stop raising rates. But at the time they see that, it's going to be too late. They're going to have already done a lot of damage. So here's what's got to happen. And this is really important. Either growth slows, meaning that the data, they see the evidence in the data that they look at, which we already know now is delayed. Okay, either growth slows by the data that they look at in 2019, so the Fed can stop tightening, or they will simply keep rating hikes until these tighter financial conditions ensure that the economy does slow down, okay? So the main thing I want to point out here is that they do want the economy to slow down and they do want asset prices to depreciate, okay? It is what they're doing right now. There's a saying, don't fight the Fed. They are deliberately trying to slow the economy down, not wreck it, slow it down, and also depreciate asset prices, okay? Neither scenario is bullish for stocks. Now, it's not the end of the world. If you listen to a lot of the people in the financial press, apparently stocks are going to zero. That's not going to happen either, okay? So you got to know how to trade this stuff, but we got to understand that neither scenario is bullish for stocks, okay? So, again, it takes 6 to 9 months for all the numbers they watch to work their way through the system to show that slowdown. But in addition to oil, which we just looked at, it's also really clear companies like FedEx, the transportation sector is getting decimated, right? They're on the front lines of this. A lot of times people ask, well, why is transport's a leading indicator? I thought that was just railroads and stuff. It's because they're shipping stuff, all right? And FedEx has already seen drops in demand globally for their package. Now, there's some trucking companies that have got business for the next year, okay, but it's just those little chipping away at it. They may not see anything for a year and see any slowdown there. So that's the kind of stuff that's happening here. Now, here's another thing that's important to understand. The Fed is also scared of running what's called a high pressure economy. So in a speech in October, just a couple of months ago, Fed President, I don't know if that's Bostic or Bostic, but I'm going to say Bostic. He talked about the risk of running a high pressure economy. Okay, this is defined as an economy where unemployment is below its non-accelerating inflationary rate. Okay, to me, that is gobbledygook. But so what does that mean? What does non-accelerating inflationary rate mean? Well, it means in English, this means that in a high pressure economy, you run the risk of creating excess in both the real economy and the markets. Okay? The result is either the Fed is forced to aggressively tighten or when the bubble bursts, deal with that instability. Okay? Again, this is hard. This is not an easy job for the Fed. They got to sit there and say, well, we want the economy to grow, but not too fast, because if it grows too fast, then it's going to implode at some point. And if it implodes, we're going to have a bigger mess. Okay, so it's not easy by any stretch. Yeah, and TC, I totally agree. So he's just saying 1980, 82, very high interest rates. The Fed is using a model that is almost 50 years old. Technology has improved exponentially in that time. Is the Fed, yeah. So is their head wedged where the sun doesn't shine? And yes, they're using old models, and it's a problem. It's a problem. So, okay, so it's important to remember that based on the past actions, all right, based on the past actions, the Fed looks seriously at climbing wages and the stock market. Okay, again, another important point here to hit home. If having to choose between hiking rates to slow down wage increases caused by a runaway economy or cutting rates to offset a stock market weakness, the Fed has always stuck to their mandate and tightened policy. Okay, so this is really important, guys and gals. Basically, they're watching the wage numbers. Okay, now oil plummeted, right? Guess what? The wage numbers are going to fall simply because the oil industry. But that's not going to happen for 90 days. That means they'll probably tighten one more time. Although this last stock market fall may give them pause, maybe. But again, if it's between saving the stock market, okay, or slowing down wage increases caused by a runaway economy, they will always choose, or at least in the past, they have always chosen to focus on those wage numbers. As long as the wage numbers are going up, they're going to keep hiking until they see evidence that they're not going up anymore. And again, I'm saying oil is already telling us that it's not going to happen, but they've got to see that coming in the numbers. Yeah, so what's interesting, John is just asking, are things falling much faster? What's happening right now is everybody kind of knows this now, and so they're front running it. It's literally front running the slowdown. Like there's no signs of a slowdown, but large funds are front running the slowdown. Yeah, it's pretty fascinating. So, okay. All right. Now, again, I just saw someone saying, "Hey, the Fed isn't our friend," and yeah, it's an archaic system. It's what we got, right? So one of the things I always like to look at is, looking at reality head on, is that we're stuck with the Fed right now. If for some reason they go away, we'll deal with it then. But it's like, all right, this is what we got. How do we trade it? How do we prosper in this environment, right? So the Fed's objective is not to tip the economy into recession. They don't want that either, okay? But that's what they're doing. I mean, essentially, they are putting us into a recession. But the alternative that is keeping up at night, and this goes back to the old models of the 50 years ago, is that if they stop tightening, and this is where I personally think they're ridiculous, if they stop tightening due to stock market weakness, okay, but wages are continuing to increase, there's a chance that inflation will embed itself into the economy. Okay, and then they'll face the horror show of the 1970s, which is they want to avoid. That is what's driving their action. I think that is a flawed premise for two reasons. One, okay, if they look around, they're going to see that we have a lot of debt out there, and with that much debt, it is almost impossible to generate inflation. Two, baby boomers control something like 80% of assets. Okay. That is deflationary because baby boomers are not doing anything with them. They're essentially sitting on all the assets. They're not trying to accumulate more. It's not, what they're doing is deflationary. Okay. And again, the Fed does not take that into account. So they're looking at older models that are flawed. They're not taking into account reality, and they're going to tip us into a recession is what they're going to do. So I think what's going to have to happen is they're going to overcorrect tightening, and then they're going to have to start reducing rates again. Like I actually think we just saw the highs in interest rates. Like interest rates ain't going to 6%. The bond market's already telling us this. The Fed is going to have to pull its head out and get things going there. So it'll be interesting to see. Now, the housing market started showing signs of weakness in March when mortgage rates started to rise. So the one benefit that's been happening right now is that the bond market is exploded is a probably not the right term, but the bond market has rallied hard, and that's been driving interest rates back down. In fact, we can look at 10-year notes. But the housing market started showing signs of weakness in March when mortgage rates started to rise. Basically, starting in February and March, that's when all the home builders started to crash. Basically, loose monetary policy inflated houses to well beyond their 2006 highs, okay? These higher prices combined with higher mortgage rates essentially meant affordability took a nosedive, okay? Wages are going up slightly, but not nearly as much as home prices, and then the payments required to essentially live in those homes because of interest rates. So essentially what happens is that while the $200,000 and below market is still white hot, you get to 500K and above, that market is just at a standstill right now. So although 10-year notes have turned higher, and this is just what kills consumer confidence. So if someone's trying to sell their home and they can't move it, or they're priced out of a market, it kills confidence. And when confidence is killed collectively as a nation, that hurts a lot of things as well. So, well, the other thing too, Scott just brought up a good point. And here's the other thing. I mean, this is to me, so, and again, all these numbers I'm about to say are just ballpark. So keep in mind. So I'm going to say 2005, the government had something like $4 trillion in debt, and their interest payments annually were $380 billion. Okay. And then you flash forward to, I'm going to call it 2016. I think it was something like 20 trillion in debt. Okay. And guess what? The interest payment was $380 billion. So the interest rates, on 10-year notes went from 5%, down to 1.5%. So you could load up a ton more debt and still have the same monthly payment, right? Awesome. So all this debt wasn't a big deal when interest rates were staying low. But if they have to start refinancing that at like, say, 5%, then, I mean, this goes to like $1 trillion a year in interest payments. Who pays for that? We do. Okay, that means tax hikes. So I think the central banks knows this, and they just know they cannot have high interest rates. Like, they're screwed on so many levels. So long story short, the important thing to also remember too, and I've got a chart somewhere, but if you look at interest rates over the last like even 500 years, there was 2 times when they got up to about 15%. Okay, so there was the 1980s, and then there was I want to say it was like the 1500s or something like that. That's the only 2 times they've been that high. In the 1500s, it was because of all the money that was expansion for conquering the world. 1980, you had all these weird policies going up, but the average inflation rate has actually been between 2 and 6% for the last 500 years. So the idea that all of a sudden interest rates are going to go back to 15% is absolute hogwash insanity. And I don't even think we're going to go back to the top of the range in the last 500 years. I think we may have actually just seen the highs. So now, so global money managers here have also been a pickle. Well, Tay, so I actually don't think they can afford higher interest rates, so they're gonna have to drive them down, and the bond market's already doing that for them. So global money managers have all this data, like what I'm telling you right now. The Ray Dalios of the world have known for a year. But so they were all hoping, though, for the fabled Santa Claus rally to take shape so they could unload their positions onto the public. Like that, I've talked to a couple money managers, and that was literally their plan. Well, gosh, the market's going down. We see the writing on the wall. Let's get that Santa Claus rally. Let's unload this stuff, put some lipsticks on this pig, and we'll hand it off to an unsuspecting public. And then we'll have a great, year. So what happened, of course, and what they want to do is they want to send, they kind of live, and this is why if you're worried about the market and you call your, like, say, stockbroker or your money manager, they're always going to advise you to just leave your money in, because that's how they get their fees. If you take it out, they don't get paid, right? So what their goal is, when they send their end of year performance letters to investors, very few buy and hold long types are going to be able to show a positive performance this year for the first time in a while. Now, if you remember, in January of 2018, there was FOMO, fear of missing out, in terms of new money coming in to catch the wave of the last 2 years. Again, a record $100 billion came into the markets in January. In January 2019, instead of FOMO, it's going to be, oh no. People are going to look at their statements, and people are people. They're going to react to that. If markets are going higher, they want to buy the highs. If markets are going lower, they want to get out. Just like when Bitcoin hit 17,000, that's when people started taking out mortgages to buy Bitcoin. Exactly. There goes that bonus. So as we know, the markets have been getting crushed, and unless the Dow can rally like 3,000 points into the end of the year, they're not going to be able to show anything too exciting to their investors. So what's happening right now is that analysts on a global scale are reducing their earnings per share forecasts for 2019. And this is how the game works. As the stock market continues to fall, they continue to reduce their EPS forecast to match the stock price, right? I mean, it's kind of a joke. In other words, lower stock prices will cause continued lowering of earnings per share forecasts, essentially because they look at things from a price to earnings ratio, right? So it's like, man, if the stock price is falling, that must mean that the earnings are going to fall, so we better reduce our earnings per share forecast. And this, in turn, of course, continues to lower stock prices. We'll talk about what potential bottoms are. Now, are there buy points out there in the market? Yes. So I've got orders to buy. In fact, we were able to pick up some Netflix because Netflix actually got down to $230. But there are large open gaps that present a buying opportunity should we get there. Netflix has a huge open gap at $228 that was created on January 22nd, 2018. On Monday, I think it traded down to $230, and that might be close enough. Amazon on October 26th has an open gap at $983. Apple, $121, Google, $893, Facebook doesn't have any. If we get into some panic modes, write these down and set alerts, okay? Really, this one's already been hit, so especially for these three. Those will be nice buy points, okay? This is what happens. The whole idea of a market like that is to erase the gains of the bull market. Fill those big unfilled gaps, all right? It's called capitulation. We'll talk a little bit more about that. Also, the SPX 2400 level has been described by a lot of hedge funds based on the data that they look at as the Powell put level. Okay, what does that mean? Fed Chairman Powell at some point cannot ignore the stock market going down, down, down. It's okay if it falls 20%, okay, but at some point he does not want it to fall 50%. All right, that screws his plan up. So at some point he's got to or will intervene in the markets, the whole fabled plunge protection team. And all the hedge funds, at least that I've talked to, have pegged that level at 2400 for various reasons. Now, notice on Monday, we tagged 2400 and closed a little bit below it. I think we pushed maybe 30 or 40 points below that. Look what happened on Wednesday. Look what happened today, okay? This stuff is real. They don't want the markets to fall apart. They don't want the markets to fall apart. So what that means is that's where the Fed would officially get nervous and start saying things to support the market or doing things to support the market. Okay, but remember, that does not make quantitative tightening go away. It does not make it go away. They just don't want it to fall apart. So, yeah, John Arn, that's a good question, and honestly, I think they're in a pickle, is what they are. Like, if they can, their goal right now is just to slow down the economy a little bit. And then it's like, okay, let's just stop raising rates. I think for them, that would be a perfect world. So what are the best longs right now? Steve has got a question here. Let me see, there's a couple of good questions here. Tony, don't you think we should have at a minimum the Fed funds rate, at least at the inflation rate? Yes. So right now, inflation's at 2.5%. The idea of getting Fed funds slightly above that means at least people now can put their money in that, not get eaten away by savings. That's an ideal situation for them. Simply put, all the QEs have bought millions of shares of everything. Yeah, okay, let's talk about the shares. Okay, so here's one thing to keep in mind. And I can't remember if I have a slide on this or not. Let's go back here real quick, because I forgot. I can't remember if I actually have this on a slide, and I might not. Okay. So one thing to clarify here with quantitative easing is who bought the shares, okay? So why, when the rest of the world markets were falling with the start of quantitative tightening, why did the S&Ps rally, okay? What happened here was tax reform, and this was just US based. And with the tax reform, what happened is all the big companies were able to repatriate, which means bring in all that cash that was sitting overseas back into the US. Okay, what did they do with it? Well, they built some buildings and built some headquarters, but a lot of them just started buying back their stock. And that's why we had an extended rally. So in this case, it's not the government that was buying shares, right? Apple bought its shares. Boeing bought its own shares. All these companies had all this cash sitting overseas that they were finally able to bring back, and all they did with it is bought back their own shares. So it's not them dumping the stock. It's just that that's what the money was used for. It's important to understand this because a lot of times, people got confused with this because it's like, well, if there's quantitative tightening and the market's going up, that just, we're on fire. But all that money that came overseas went back into buying their own stock. Well, that's obviously done at this point. Although I think Boeing actually did some announcements with that as well. So yeah, so essentially with tax reform, it just added, it was kind of like throwing a couple more logs on that fire. Okay, so, and we'll look at that 2400 level too. So what are the best longs right now? So right now, so we did have a fairly large put position in TLT. And on that, it fell about 13 points, and we cashed that out. And then as of Thanksgiving, we switched and went long. So I actually think at this point that what's interesting here is that the Fed is raising rates, but the 10-year bond and 30-year bond is going up. The 10-year bond and the 10-year notes and the 30-year bond are saying, you know what? I know you're raising short-term rates right now, but we see what's happening on the economy, and we're going up. Okay, so the bonds and the notes are already pricing in economic weakness. They're telling us what's coming. Okay, that's not going to end anytime soon. They're my favorite longs right now. So besides the fact that bonds are already pricing in the coming economic slowdown, they're also reflecting a reflection of deflationary forces, i.e. crude oil, excessive debt, as well as a place to park money for large pension funds that have obligations to make and don't want to risk more losses in the stock market. The other thing of tax reform, okay, when all these large companies were able to repatriate the money, the other thing they did is that they shored up their pension funds. Okay, a lot of these pension funds, and again, I'm just going to use random numbers here, but let's say that over the next 15 years, they've got $1 billion in obligations to pay out to their pension, but they've only got, say, $600 million in there. That means they've got a shortfall of $400 million. Okay, almost all these pensions had shortfalls. With the tax reform, the ability to repatriate that cash, they would maybe drive this up to $850 million. So now that gap is much smaller. Well, guess what? They're looking at the stock market. They're going, well, I'm not putting my money in the stock market. Let's put it somewhere safe where we can get a return. That's bonds, that's notes. All right. So there's a couple of things going on there that's driving that. So this is a monthly chart of TLT. You can see at this point we've had a fantastic rally. So we were really bearish on this, up on this rally, and that's where we were adding puts. And target was actually, this is the 1272 extension. And now at this point, you might look at this and say, oh, well, gosh, we're just going to rally here and turn over. I actually think we're going to go up and at least retest these highs. So I think there's still plenty of room to the upside on TLT. Now, the other thing to keep in mind about what's going on here. Now, do you guys remember what caused the 2008 financial crisis? What happened? What bubble broke? Yeah, so yeah, exactly. MBS. So essentially mortgage-backed securities, anything having to do with mortgages. All right. So they were just, they were creating these shit loans, packaging up and selling them. If you haven't seen the movie The Big Short, I highly recommend it. Well, what's happening right now is, yeah, there's a little bit of shenanigans going on in the mortgage place, but not to anywhere to the extent of what was happening in 2005, 2006. But right now it is corporate debt. Okay. So the question is corporate debt now. That's that's the whole thing. I mean, in terms, in the search of yield, PE firms, they're going out, they're borrowing tons of money to buy companies. So essentially it's a carry trade. They borrow money at 3% and then buy a company that's generating 8%, right? That's what's fueling the whole PE market, takeover market, all that kind of stuff. And it's gotten so big, the question is that going to implode? All right, and now there are CLOs out there, company or collateralized, is it company loan obligations or whatever the terminology is, but it's similar to credit default swaps and stuff like that. So it's very hard as a retail trader to play that. Okay, back in the mortgage crisis, as a retail trader, I could not buy, I couldn't short credit default swaps, but I could buy puts on Lehman Brothers. I could buy puts on Bear Stearns. I could short the housing market. Same thing as today. Well, we can't go out and short credit default swaps on corporate debt, but HYG is an ETF. And believe it or not, the implied volatility on it is only 17%. So you can buy longer term leaps on this to the downside. So I'm looking for this to at least go to 70, if not more. If we turn into a full-blown crisis, then we're going to 65, 70. Okay. And so that to me is a way to play what's happening right now fairly safe. Okay, it's good to have that as a part of your portfolio. Yeah, in the open interest, I mean, this thing is trading huge volume. Yeah, huge volume. Okay, so a couple of other things here. In 2017, we saw a record 241 days without a 3% drawdown in the S&P 500. By record, I mean in the history of the stock market. Okay. What's funny is I was talking to Danielle the other day, and she's like, this volatility is new. I'm like, honestly, it's pretty normal. Every 18 to 24 months, you get a period like this. It's pretty normal. And I was actually surprised when we wouldn't get it. It's like, oh, the market's closed below the 21 EMA. Let's short. And like 3 days later, we're back up above it. It's like, huh. I wasn't used to that. I was more used to like, oh, we had a 9% drawdown. Awesome. Let's short that puppy. So in 2018, 3% drawdowns are kind of now part of the backdrop. I mean, we're seeing, and by drawdowns, I mean movement, 3% moves in the stock market. And we're seeing that all the time. And that started in February when those short volatility funds started to blow up. And now, of course, after that, stocks recovered, and especially FANGs, and I already talked about all the corporate buybacks that were happening, and they rallied hard into September, kind of define what was going on in the rest of the world, giving everybody a false sense of confidence that this bull market was going to last forever. Now, the day that this stopped, okay, like on October 3rd, Powell made a comment speaking to a group of high-profile investors at Jackson Hole, Wyoming at a conference, and he said, and this is a quote that will go down in infamy, "We are a long way from neutral." Okay, when he said that, essentially everybody in the room was like, oh my God, this guy is going to aggressively raise rates. Okay, now he has recently come out and said we're a lot closer to neutral. Okay, so that's helped kind of stem the tide, at least as we've seen a rally here the last couple of days at least. But when he said that, it was just like, oh my God, this guy is really serious about quantitative tightening. So essentially at this point, the tide has turned. Okay, the tide has turned. We saw 10 years of quantitative easing and low rates, and this fueled debt-funded stock buybacks. Okay, you can borrow money at 1.5% and buy back a ton of your stock. That's a great use of debt, right? Markets rarely go up in straight lines, although 2017 was as close to a straight line as you will ever see. Okay, if you go back and look at the markets, from 1900 to now, you don't see that very much. I don't think you actually see that at all. I mean, there was months, but not a whole year. But they also don't fall in straight lines. Okay. Now I know as of Monday, we'll talk about Monday. But as of Monday of this week, we saw 7 days in a row of bloodbath. And of course, at that point, and again, remember, my one of my mentors was Peter Borish. He wrote the foreword for my book. He was the head of research for Paul Tudor Jones. And one of the things, there's two things he told me: price before news, and then discipline before vision. And these were his two watchwords. And essentially what this means is that first price, then news, okay? When the market was rallying, even though there was QT and all that kind of stuff, the news ignored that stuff. The financial guys would go through the 10 headlines of the day and to say, oh, let's pick this one and this one and this one because the market's up, so we're just going to say there's good news. Okay, never mind all this stuff about quantitative tightening and all that. But now that the market's going down, they'll see the same stories and say, oh, that's bad news, and that's bad news. That must be what's happening. Okay, they have no freaking clue. They just look at the price and then they try to find news stories that match the reason why price is either going up or down, and they actually have nothing in common. And then discipline before vision is also very apt in this market, meaning you may think the market's going to crash. Don't be so convinced about it that you don't put in a stop. Have the discipline to put in your risk controls before you get caught up in your vision of the market crashing. Okay, and those two watchwords of, they're going to serve you very well. So bear markets are different than bull markets from a trading perspective, way different. In bull markets, things are slow. You can hold through the pullbacks. You can ride out the wiggles. Bull markets are very forgiving. Patience is rewarded, okay? You can buy breakouts. In a bear or a down market, you cannot just do the opposite. It's like, oh, great, I'll just short and this and blah, 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 blah. In down markets like this, you've got to take bearish positions. And when I say bearish positions, I mean shorting stock, shorting futures, selling call credit spreads, anything that would benefit, buying long puts, anything that would benefit from a market going down into the grind rallies, okay? And then you almost always have to take some heat, more than you want. And then on the days when the markets roll, okay, and the moves accelerate to the downside, you've got to take profits into the selling, okay? You've got to do that when you're a certain percentage away from the 8 EMA on a daily chart, because it's just not going to go much further than a certain percent, okay? You've got to do that when things like the 10-day moving average of the put-call ratio go over 1, which it did on Monday. So there's things like that when you start holding short overnight in situations like that, you risk a Wednesday, okay? So just because the market goes down hard for 7 days in a row doesn't mean it's the end of the world. So let this mindset dominate in 2019 until it stops working. Okay, and I anticipate this volatility and continued downward pressure for some time. Just keep in mind that bear market rallies are 5 times faster and 5 times more violent than bull market rallies, as you've seen over the last 2 days. They're amazing. This is the best day trading market anyone could ever hope for, but you've just got to understand how they work. Okay, and keep in mind that bear markets always look like it's the end of the world, but typically when it looks like it's the end of the world is when you're going to get one of those ferocious rallies. Okay, but in the end they kind of fizzle. I actually think the current rally has a few more days to it. We'll talk specifically about that. But what we need for this to change is capitulation, and frankly we have not seen capitulation yet. So yeah, exactly, Eric. Stairs on the way up and an elevator on the way down. Okay. So what I want to show you is what capitulation looks like. Okay. Now, if you guys remember, March 2000, we had the top, that whole 1995 to 2000 tech bubble. So the S&Ps sold off, and then around February of 2003, we bottomed, and then we rallied into 2008. Okay, stock market here went up about 100%. 2008 financial crisis hit, and then boom. What happened in a course of about 6 years, 5 years, essentially was puked up in 5 months. Okay, so 5 years of gains vanished in 5 months. That's what that typically looks like. And then what happened was, for capitulation to take shape, we actually had to take out those lows. Okay, we took out those lows, and that was March 2009. Then and only then did we get capitulation. And capitulation means that the guy who bought right here and held all the way through finally throws in the towel and says, screw this. Okay? At that point, there's no more sellers and we're free to rally. So that question being said, what does capitulation look for this time around? Well, capitulation looks like this. Okay, so we had the nice rally here. I don't think we need to go all the way down to the 2009 bottom. The last major bottom was right here at the beginning of 2016 at 1800. And if we were going to wipe out all of the gains of the last 3 years over the next 3 to 5 months, we would need to go break this level, okay? Now, do I know for sure that we're going to break this level? No, of course not. I don't know. I don't know if the Powell put is now enforced, right? By the way, let's look at an updated chart of this, because this is a chart that's like a week old when we were at 2465. Remember when I talked about the 2400 strike price there? In fact, we'll look at an updated chart of that. Let's actually look at that real quick. So if we look at the SPX, and now here's a daily chart. Now you can see there's 2400. That's that Powell put level, right? Well, we sold right off into that, and magically, boom. Now all we've done at this point is we rallied back to the 8 EMA. It's a fantastic rally, but that's what happens in these type of markets. And so the question is, now if you look at what's happening right here, over the last, you saw this like 7 days down, and then we started to rally. Well, guess what? This exact same pattern was happening in 2008. And so you want to understand how these things kind of work. And so if you look at here, this happened in October of 2008, you had the exact same move down, okay? Now at this point, we were trading around 1200, and we dropped down to about, 900. So that's a 300-point drop, okay? Percentage-wise, this was much bigger because this started at 1200 points, right? It didn't start at 2600 or 2800. Now look at this. If you guys remember the headlines here, it was the end of the world, okay? And with this end of the world, what happened? We had this huge rally, okay? And it took us almost to the 21 EMA, and then we came down and we retested the lows. Then we actually went up to the 34 EMA. All right, then we took out the lows, and then we spent, almost 4 months in a chop mode. Okay, so at some point in the near future, we're going to go into this mode. Then for good measure, we took out the lows one more time, and then finally, this was the bottom. Okay, so you got to understand what a bottom looks like. And the main thing for a bottom is that you first got to get that 821 EMA cross. Okay, and we did kind of have this kind of head and shoulders, kind of thing going on, but essentially a lot of times things like this, it looks like just kind of a big kind of a W, that kind of thing. And so just keep in mind that if we are going to see a bottom, the first thing we've got to get to is an 821 EMA cross, and we are nowhere near that right now. Now, the thing about markets like this, and this is a screenshot from today, okay, and the thing about volatile markets like this is that, when the markets it's a slow bull market, to me, I actually don't like to day trade in slow bull markets, but a market like this, absolutely. So this was something today where we were watching this in the room, and right now what's great is that the bond market is moving before the stock market, okay? And when the bond market broke, and you can't see all of it here, I can bring up a chart, that was great. We went long S&Ps, long the Dow. There's one contract of the Dow, okay? This was good for almost 700 points. It didn't even pull back today. So one contract was good for $3,400. Here, this was one where when the ticks are like this, you can see when we're getting plus 1,000, plus 1,000, plus 1,000, you buy every pullback to zero. And in this case, we would just buy contracts, and that was good for almost $7,000, just trading, one lots and stuff like that. So in this kind of a market, and obviously on the days where the markets, the ticks are down like this, great. Then you short rallies up there, and from a day trading perspective, it's fantastic. So how much to buy one lot? So for the margin on one contract is $5,000, but for some brokers like this one, you can do it for $500. It's just called day traded margin. And if you know what you're doing and you've got a good setup, it's pretty easy to do. All right, so that's what I want to show about. And then the last thing here I want to talk to you guys about is just the concept of our plan for 2019, what we're going to be doing in the markets, essentially what I think will be very, very helpful. And one of the concepts here that I'm a fan of is something called masterminds. If you guys are familiar with the mastermind group, Napoleon Hill introduced this in Think and Grow Rich, okay, which is a book I read as a kid, and I thought it was obviously very interesting. So mastermind groups bring together people in similar situations on a monthly, weekly, or even really a daily basis. You discuss challenges, you tap into the group's collective intellect, and solve problems, okay? It's kind of peer-to-peer mentoring. whose member, trust each other, swap advice, create connections, and focus on collective individual successes. Now, I am in 5 different mastermind groups. I've got one for trading. Okay, and it's just a group of us that, we're traders and we get together and we talk about it. I'm in like YPO and EO, and those help me just essentially, it's like, okay, if we're going to try to grow simpler, I need to talk to other people that are in business and just kind of say, well, what do you do in this situation? And what do you do here? And then just some other masterminds that just talk about different things. But what happens is then once a quarter, you get together with these people, and they're people that are in similar situations as you, and you just have some raw, honest conversations and exchange information, and you simply improve as a result of it. It's pretty amazing. I love the concept. So we've actually never done a mastermind before. So we thought of it and we've been thinking about this. And so we're going to do 2 things in 2019 that we've never done before. And I just want to show you what they are, just so you're aware. And we've got 2 things here. And we've called, one of them is just called Platinum, and one of them is called Titanium. And simply because those are the names that we could only think of. So what we're looking at here is, with one of these, is that would include a mastermind group, and another one is just like, you know what, for those of you that have been with us for a while and you're like, you know what, I like what you guys are doing, I do a lot of stuff that you guys do, and a lot of people have said, I like everything. If I just commit to just doing everything you guys do, could I get a significant discount on that? And so this is kind of a way to get a 50% discount on everything that we're going to do in 2019. So what's included? So Platinum, we're going to do setup where once a quarter, we're going to do a 1-hour coaching call with myself, with the traders that you work with, and just actually have time to check in and say, all right, look, this is what I'm doing. This is my plan, what I'm going through. We can look at your chart setups, kind of whatever you guys want there. We're also going to set up a private Facebook group for both of these. This way you can more readily access everybody else in that group, kind of a peer-to-peer network, as well as, myself and everybody that's in here, and to say it's just a fast way to get develop a more kind of a personal relationship and talk about what's going on in the markets, okay? Free access, or it's what's included, is active. We're going to do in Austin in April, we're doing our live mentorship. So access to the live stream there, if you'd like to do that. Every membership that we do, we have 8 different memberships: options, futures, scanner, S3, all voodoo lines, okay, all included. If you signed up for all of those individually, it's $11,280 a year. Those are all thrown in. All of our classes for 2019, typically over the last 5 years, we've averaged anywhere from $10,000 to about $15,000 a year in classes. My class, Raghee class, a Carolyn class, Bruce class, that's typically about how much we end up doing. Includes all that. All the indicators that we release includes all that. Any live trading session that we do includes all that. And then, of course, live acts. Actually, if you want to travel to Austin, you can actually have a free ticket to that. Now, where these change is that on the Titanium, you also get, it's a mastermind. So we're going to have one meeting in the Cayman Islands, okay, where, again, the group of us that are in this mastermind, we're going to get together for a couple of days, talk trading. And we're also going to do another one in Austin, okay, on any live events that we do, because we're going to do a couple of regular live events that are separate from the mastermind. You can attend all of those, plus any of the breakout sessions. And as part of the Titanium, especially if you've been newer to us, you get access to all the classes that we've done in the past and all the indicators that we've done in the past. The value on this one alone is $26,000, and the value on this one alone is $80,000. So what does this all mean? So if you're interested in going all right, 2019 is going to be crazy. I want access to everything you guys are doing so I can maximize this. I want to have access to you guys in the Facebook group. I want to have access to other people who are trying to take their trade to the next level. And I want more one-on-one coaching. And I just want everything you guys are doing at a 50% discount. This is what the Platinum offer is, and it is essentially valid until the end of the year. So it's 4 days, 5 hours, and 16 minutes from now. And then for that, instead of, if you're going to do everything, and instead of paying $26,000, it's $13,000 for the entire year. And if you're interested in that, just email us, support@simplertrading.com, and we can take care of that for you. check, ACH payment. You can do credit card, but usually something like this, it's easier to do it that way. Or if you would just like this to do this as a payment plan, you can do it right here on a credit card. It's $1,997 now and $997 a month. And again, you get all that stuff, and you end up saving right at 50% on everything by committing to it now. And what the mastermind package is, so while the platinum package is essentially going to end to sign up for in about 4.5 days, the mastermind is limited, and you have to apply. So I've done a lot of masterminds, and the best mastermind groups have about 12 to 15 people or less. So we cannot do this. If 30 people want to do it, we can't do it with 30 people. So I have done masterminds for the last 7 or 8 years. This is the first time we've ever done a mastermind like this, with you guys. But I've done this a lot. I've seen what works. I've seen what doesn't work. So I'm very, very confident in my ability to essentially form a mastermind group and make sure that we all get a ton of value of it, including myself. We're going to be sharing a lot of stuff. There's going to be a confidentiality thing. It's like, what happens in mastermind stays in mastermind. I'm going to really be able to talk about some cool stuff. Again, if you want to, as an upfront payment, it's $30,000. And again, I know that's not for everybody. If you're just starting out, I got a $5,000 account. But if you've got some experience, you're trading a bigger account, and this is a huge value there. Also, too, you could do it as in payments, $10,000 down, $1,997 a month. And again, you have to apply for this. We can't do this with 30 people. So to get 30 applicants, we got to kind of whittle it down to like the 10 or 12 people that we think would be the best fit. And again, just and I'll just leave it on this page. So to get to this page, all you got to do is go to simplertrading.com/trade. It'll take you to the sign up page. You can read more about it, and you can, of course, give us a call here at the office. And then I'll just stick around here and answer questions. I mean, there's a lot of interesting stuff going on in the markets right now, of course. Keep in mind the titanium package includes all of this stuff. And then if you want to go to the page and really check this out, go to simplertrading.com/trade. And you can also give us a call here at the office right there. Okay. So that's what we got. All right. Questions. Chris, what will happen to cryptos next year? Cryptos are dead in the water for now. So there's a lot of things going on there. We're not going to see Bitcoin. I don't know if we're going to actually ever see Bitcoin ever eclipse 20,000 again. I'm actually very dialed into that. I talk to people who manage funds that do this. But there's some things that have happened in this environment that are a scam, mostly with Tether. And until that gets unwound, cryptos are not going to get a chance to rally again. I like cryptos. I haven't traded them in a while. But anything that moves like that, I'm always kind of following. Oh, yes, thank you. Okay, oil stocks. Okay, so a couple of oil stocks here. One is RRC. This is one, if you guys remember that we did one about 1.5 years ago that we talked about, and that thing went up 10x. This is the same group, okay? So this is an oil stock. And then there's one with a 12% yield, and let me grab that. Let's see here. Hold on just a second. And so I will grab this real quick because I want to get you guys that. And it's a 5-letter symbol. So I want to get that for you guys. Let's see. Where'd it go? So anyway, let me find that. I'm going to do. Okay, so I've got that searching here. And off in the corner. Okay, I'm going to keep answering questions. Yeah, so RRC is a stock. This company is very well financed. You've got billionaires up in the Dallas-Fort Worth area that are loading up on this. In terms of a longer-term prospect, I mean, oil doesn't actually have to go up from here for it to do well. Obviously, that would help, but it is at a really, really solid level. Gold thoughts. Well, so So for gold thoughts, yeah, and Jill, I'm finding the one. I've got this. Let's see, there, the MP, yeah, MLP select 40 alpha. Okay, so yeah, let me get that one. I just want to make sure it's the right one. I do see oil prices at least leveling off from here. I don't think they're going to plummet from here. Yeah, no, Rachel, it's so I know like John Goff up in Fort Worth. I know him, and he's been loading up on it, and he's very, very smart guy. Worked for Richard Rainwater. So from a play like that, these guys are not, they don't play around. Oh yeah, and by the way, yeah, there's on the 31st we are going to be doing a tax loss selling class. And that will be from, now the markets on the 31st actually do not close early. So that'll be from, I think, like open to 11, then a couple hour break. And is it that one? Okay, so let me see what other questions are coming up. All right, let me check this one. I want to see if this one has options. Excellent, excellent. MLP. Okay, I think that's it. Yeah, okay. So for the fund that I was talking about that's yielding 12% right now, it is an oil and gas fund through Oppenheimer, symbol MLPDX. Okay. Right now, this is $4.87, and it's yielding 12%. Essentially, what they do is invest in a bunch of other kind of master limited partnerships. This is a record yield for this fund. Expect this stock to go back to like, $8 or $9, and essentially at a 12% yield, all of a sudden it's like, okay, that's pretty legit. So that's what I like. For some people that like to do kind of the longer term stuff, actually right now it's 12.61%. So again, RRC, this is just an oil stock. A lot of very wealthy players in the oil industry in the Dallas-Fort Worth area are piling into this. And it's just something that I know because I happen to know them. And then MLPDX, this is a fund where a couple of money managers I know loading up on this, putting their clients into it, just because it's a rare opportunity to get into this where it's really, really high quality infrastructure related stocks in the energy industry, right now yielding 12.61%. Typically through a fund like that, I mean, on a chart, you'll just see the closing price, but it's typically something that you have to do, like, like on Charles Schwab, they'll have the list of all the funds you can buy and different things like that. Yeah, it is on the entry like that, for sure. And okay, so let's see what else. Do you think that we're going to get the January effect where beat up stocks get bought? Yes. So Colin, on the 31st, I'm going to do a class that talks specifically about that. Now, there's a difference between the market going down and then stocks that are specifically set up for tax loss selling, but we'll be looking for some of those. What are good question. So what are the breakout sessions on the Platinum? So on a breakout session, typically when we do a live event, yeah, this actually isn't. So like when we just did our event in San Francisco, we had a couple of breakout sessions. Like I did a breakout session, it was like an hour. Raghee did one. Basically, they're they were essentially set up for people who had done other classes. But if you're part of the titanium, you can just go to them. Jill, taking a look at the RRC chart, who'd buy this? Well, that's the whole point. Billionaires are buying it because it's at that level. Do you expect the month of January to be bad? I do. I do think January is, I mean, I think any rally that we're getting now is shortable, but I actually think the current rally has a little bit more to go. John, your third edition of Mastering the Trade is just good. Oh, awesome, Aaron. Appreciate it. Yeah, no, for sure. We can definitely email those out. Oh, yeah. So if you're trading, if you're doing any index trading, just make sure that you're watching the 30-year bond. And by the way, the whole point of like the platinum and the titanium for next year, and especially with the mastermind, is, you know, I mean, typically like these big picture outlooks, I'll do them once in a while, but for something like that, it's just, you know, we'll talk about, so the stuff that I talk about in the mastermind is like, you know, not only is big picture stuff, but like really diving into like trading details. Like, okay, here's some stuff that you guys can do with mechanical systems, and here's some things like this that you just can't really, you know, it's stuff that you can't really share, like, oh, trading room, or, you know, it's more like regular charts and things like that. And so there's a lot of things that you can dive into in a mastermind that you can't really do normally, and so that's part of my motivation for doing that. Plus, I like, you know, masterminds are fun. You actually make really good friends and stuff like that too, and so it's just a way to do that. And then the platinum really is just like, all right, you guys, what you guys are doing, I want to do it. I want to do everything. Is there a way if I sign up for everything, I can get a discount? And basically, with this, you get, it's actually more than a 50% discount, but it's essentially, it's a way to kind of lock in kind of like a 60% discount, 60% off everything we do this year. And then of course this, you kind of get that discount, but plus you get the mastermind, which is, I think is going to be pretty awesome. Yeah, and Stephanie, no worries. And I know, like, when I first saw some of these, I couldn't do them right away. It was something to kind of look towards. And again, if you're just starting out, you're trading a $5,000 account, totally get it. These aren't going to be a good fit. That's going to be more of like, I mean, hopefully on something like that, it's like at least, if you're in our options room or something like that, you can at least kind of get the day-to-day stuff. And that's certainly a reasonable way to do that. When does it start? So essentially this will start with the new year. So this package is good for the next 4 or 5 days until the end of the year, end of December 31st, and then it just starts kicking in right away. Dave, good question. Is the Platinum membership a one-time fee or an annual? So it is an annual. So if you do the Platinum, so like the 13K for the Platinum essentially gets you covered for everything for 2019. All the stuff that we were going to release in 2019 based on what we've done in prior years would be around $26,000 if you're just going to do everything individually. So it's just a way to do it at a discount. And it's not and at the end of the year, we'll just say, hey, would you want to do that again, or are you good? And, obviously you're not, it's not anything you're locked into or anything like that. Could we do 30K for a few training sessions with you instead? It's funny. I haven't done one-on-ones like that for a while, but it's something that we've talked about. So, certainly something to talk about. Scott, if you already have access to everything, assuming you have access to all indicators and past courses after 2019. Oh, you mean for the titanium? So the titanium, yeah, it's kind of nice because especially if you're newer, it kind of gets you up to speed on everything we've done. And then, again, starting at the beginning of the year 2020, if you wanted to renew the mastermind, it would be just another, just another renewal there. Gold outlook. So gold right now, I like to the upside. The biggest thing you got to look for with gold, of course, is the strong dollar. But we are starting to see some money flow into gold. At this point, I think it's going to be a short-term movement. So, if you're in it, just of course, just trail that stop. ZB is 30-year treasury. Yes, Gary. So ZB is the 30-year bonds. The 30-year bonds right now are moving first, and then the stock market is following after it. So if you're day trading, it's been great. But yeah, the symbol on that on Thinkorswim is ZB. If you are still heavy in domestic and international mutual funds, how much would you lighten up on the next leg up? Well, I am actually not as bearish as some people with this market. I don't think we've bottomed out yet. I think, I still think we've got some more upside on this current one. The best thing to do with that, if you've got some mutual funds and things like that, is, if we get rallies back to like the 21 period moving average on a daily chart, that's a good time, I think, to kind of, unload or at least add a hedge. The only way right now that we'd see a shock rally is if Powell came out and did like an emergency lowering of rates. Okay, and I actually don't see him doing that either. I see you are not expecting any SPX higher highs in 2019. I am not, Colin. Yeah, I do think we're going to get some fantastic rallies, but I don't think we're going to take out the highs. I think that ultimately we will, but it's going to be a couple years. How about the cannabis area? So I still I like the bigger names like CGC. I've been looking at some of those, but yeah, I do like to keep an eye on them. But keep in mind right now, they're overvalued. So I know they're a great trend, but all the hedge funds are still shorting them. So I do think that they have some more downside. They just got, kind of like Bitcoin, retail piled into them, drove them way beyond current valuations. So I do think that they actually need to kind of work some of that excess out. Do you see this S&P bounce getting to 2,600? Tom, I think that's actually a very good possibility. Yes. What if Trump sacks Powell? I don't know, Mike. There's a lot of unknowns, obviously, in this market. I think initially the markets would rally, but whatever happens, quantitative tightening is still happening. So somebody would have to say, "Oh, we're going back to quantitative easing," and remember, they're lightening up the balance sheet too. FANG stocks. Well, all the money went into FANG stocks, and now all the money's coming out of it, right? So right now, FANG stocks, they're essentially just moving with the market. Right now, the best FANG stock is Google in terms of a long. But remember, there's those big open, again, in the short term, but there's a big open gap way below where we are right now. So I think all the FANG stocks here, again, the market we're in right now is sell the rallies. Okay. Now remember, in a bear market, you can get 1,000-point Dow rallies. Okay. You don't get that in a bull market, but you can get that in a bear market. But any rallies to like the 21 and 34 EMAs on a daily chart generally are going to be shortable. Okay. For the near future. How much of these dramatic end-of-day trading is computer-based? 85% of all the trading right now is computer-based. There are some advantages, believe it or not, to trading discretionarily, as we like to do, as long as we learn to pick our spots. When I was in the Cayman Islands, I videotaped a pelican hunting for fish. And I think I was able to, we're probably going to upload that to YouTube tomorrow. It's a really great analogy of how to trade these markets. This pelican was patient, boom, go for the kill. Patient, watching all this fish go along and stuff like that. And it's really fascinating to watch, but he was a good trader. Yeah, AG for the, if you're talking about the broker there, that's still fine. We can talk, just email Mandy. We can you'll be set up on that. Marty, that's a good question. I mean, one of the things that, besides OPEC, but they're also making it very, they're doing a full on out trade war too against China, right? That's why it's like, so there's a couple things like that they're certainly doing to kind of, make things very interesting for sure. Did the Pelican have a copy of Mastering the Trade? He must have, because he was following all the rules specifically. Ralph, John, Russell and transports let us down. If we start to see stability in those areas, is that an indication that a bottom is starting to form? Yes. So we ain't going anywhere without the transports. Okay. Transports will have to stabilize and lead the way higher, and they are not doing that. Coruscant. So the trade station ticker for the 30-year bonds is at US. Okay, US. So on a lot of other platforms, it's ZB, but on TradeStation, it's US. They still use the pit symbol. Oh, Ron, good question. Where do you see the inverted yield curve going in 2019? Well, it's gotten close to going into inversion, and they're trying to fight that a little bit. If it goes there, obviously that's 6 to 9 months later, there's a recession, right? And remember, all that's happening right now is that the stock market is essentially front running an assumed recession. We actually haven't seen a recession. It's just that's how sophisticated people are right now, is it's front running an assumed recession. That can change if Powell comes out and says, you know what, we're going to stop raising rates. And we may ease off on the whole balance sheet thing, but he's got to say it. If he doesn't say it, the markets are assuming quantitative tightening. Okay, obviously they're going to see that with the interest rate rises, but they go by what he says. So when he said that we're nowhere near neutral, that's when the bull market ended on that day. Yeah, so what about the yen and the dollar? So right now, yeah, so yen, essentially if the yen is going up, that's generally bearish for US stocks. And by yen, I mean yen futures. Dollar yen is the opposite, the Forex. But if the yen futures are going down from a carry trade perspective, that's generally positive for stocks. Right now, that correlation's a little weird, but the bond stock correlation is spot on. Yeah, so for futures, I actually trade through multiple platforms for futures. So my main brokers that I use are Thinkorswim, Tastyworks, TradeStation, and Infinity. If I am going to do a day trade, typically I'm going to use Infinity. It's faster, I like their dome, and you can use $500 day trading margin, okay? Now, if I'm going to do a swing trade, then yeah, TradeStation. TradeStation is actually pretty good for day trades too. Thinkorswim, typically on Thinkorswim, I will only swing trade. I don't do day trades on Thinkorswim because I don't like their dome. But I like to do futures options on Thinkorswim. So each broker has their pluses and minuses there. Yeah, John, there's a huge monthly 6J squeeze too. What is the outlook for S&P 2019? So I'm looking for the first 2 quarters. I'm not looking, actually the moves we're seeing in December, I'm not looking for a lot of that, but I'm looking for more sideways to down. And then as we get into Q3, Q4, looking for kind of a bottoming out. It's going to take a while, and then starting to rally again in like mid 2020. All right. Do you think the U.S. and China will reach an agreement on March 1st? No, I don't. So China is desperate for an agreement, but they will not do anything for an agreement. So that's, at the end of the day, they will put a line in the sand. Yeah, one of the things that we did is we actually bought puts today on the VIX, looking for the VIX to also come down here a little bit. How smart is it to go 80% bonds in a 401k? Well, I personally, in retirement stuff, I don't like to see a lot of volatility. So right now, bonds are going to be much less volatile than stocks, and I'm also continuing to look for them to go higher. But I always, on something like that, is just saying, like, and sometimes cash is fine. Cash earning 1%. When things are really, really volatile, up 1% is the new, versus being down 30%, then it's like, oh, that's amazing. Okay, Gary, good question. So Gary's just saying, hey, my son and I, we trade together under one LLC. Can we join as a group? So, and I don't know if you're talking about the platinum or titanium, like the mastermind. So for titanium like that, if you have somebody that you trade with, like a spouse or like your son, yeah, just give us a call, email us. I mean, you don't have to do it for both, right? It's just more like, if you're going to be coming to Cayman, and we'll have some additional expenses there, like for food and stuff like that. So we just want to make sure that that's covered. But basically, you're able to kind of work on that together. Oh, Ron, you do? You live 10 minutes from our office? Yeah, so if you want to swing by and see us, yeah, just call, because, I mean, there's times, like, there's times when we're here, times when we're not here. But yeah, just call and set it up, and, certainly happy to, it's always fun when people stop by. If you come by unannounced, all of our doors are locked. Like, we're in a retail space, so we don't want people walking in. Sometimes we're doing webinars. Of course, during the trading day, we're kind of trading. So, but yeah, if you can just call, to set up an appointment, it's always awesome to meet people and stuff like that too. Okay, Cool, guys. Well, let's do this. It's 8:30. It's time to kind of wrap this up. Again, just wanted to let you guys know about this. First of all, of course, the outlook for 2019 going to be a lot more volatile. And again, for the first, again, just these two packages that we kind of put together, just from customer feedback, is for those of you that are like, look, I really like what you guys are doing. I'm doing pretty much everything now. If I would commit to everything, how much can I get a discount? Sure. This is a way to get 60% off everything we're doing in 2019 and get some bonuses like a 1-hour coaching call per quarter in a private Facebook group, and just get a little bit more kind of VIP attention there. And of course, the titanium, you get all that plus doing that mastermind in the Caymans, mastermind in Austin. And that's something too, as we meet, we'll kind of spend time, fleshing out what we want to do and what we want to look at. I mean, I've already got kind of some outlines what we're going to do. I think it's going to be great. Plus that history, especially if you're new with us, we've got a lot of great stuff in our archives, and it's just kind of, if you're going to do the mastermind, you might as well be on the same page as kind of what we're doing and stuff like that too. So I think it's going to be great. And then if you go to simplertrading.com/trade, it will take you to this page. And, again, if you're going to do some of the larger payments, like the $13,000 payment for this or anything like that, typically you need to do that by like a check or ACH payment. If you want to do credit card, we can try to figure that out. It's just easier like that. And then there's also payment plans for both. All right. Whew. All right, guys. Well, we'll see what the market's going to be like tomorrow. I'm going to be, if there's any trades that set up, I'll be typing those into the room. And then you guys have a fantastic evening. Thanks for joining us tonight. And enjoy the rest of the year. And looking forward to a fantastic 2019. All right, you guys have a good one.